Okay, you can. I'm unmuting the microphone for everyone, and we can begin with the question that was there. Can everybody see the Excel screen? Is everybody able to see the Excel where we were?
Yes, sir.
Yes, sir.
Yes, sir.
I don't know why this whiteboard dashes are visible. Anyways, so what was the question? How would you do it if it's a mixed project? That was the question.
Yes, sir.
Yeah. So you have to decide how much percentage of your project is going to be commercial or retail versus residential, and you'll have to calculate it accordingly. Okay. So let's say if you take this number of total, you take this number of available built up here, right here, and if you decide that 50% of your project is going to be residential and 50 will be retail, then you need to divide this into two parts, and one part you have to multiply it by 1.66, which is the residential part, and the retail part you have to multiply it by two times into two, because you're doing 100% 100% loading. Okay, if you're doing a mixed project. Okay, you want me to show you that here? I can show you that. Okay, so if you had a build-up of 29, if this was your build-up, okay, and let's say 50% was residential and 50% was retail, you ideally divide this. I'm sorry, I took the wrong number. Not the super build-up, you need the build-up number. You need to take this number 29063, and you need to divide this into two parts. So this is part one and this is part two. Okay. Yes. But basically divide this into two parts. And then to calculate the SBU, super built up, this number, you need to multiply, let's say, residential with 1.6666, which is 66%. And retail, you need to multiply by 2 because it's 100% loading. Okay, so it's 2. And when you add this 2 up, you'll get the total built up. Okay, that's the super built up, right? Any other question? So it would be around 53,280. But again, see, you cannot take that as a full number because even the selling price will not be the same. The market price of 5,600 won't apply. It will only apply to the 50% residential. For retail, you have to get another market price, and so your project value will also change if you're doing a mixed project.
Okay.
Okay. So for the benefit of this exercise or this project, I would suggest you stick to either residential or commercial or retail purely. I mean, it will be easier for you guys. Okay, so let's continue ahead. So you got an idea about what's not included in FSI. I'll share some building bylaws which explains this. And you understood what the super built up concept is. Now let's look at the cash flow, which is very important. Very important. So what I've done here is I've assumed that this project of 1,000 square meters of land with a residential uh, real estate type. I'm assuming this is a 1 year project. Okay, so I put here 13 cash flows. Cash flow 0, 1, 2, 3, 4, 5, 6, 12. That's 12 cash flows. Cash flow 0 is the initial investment that you make in a project. So that is something that is happening before the month starts. And so this is at the end of month 1, month 2, month 3. So if you have a 1 year project, there will be 13 cash. Because the first is the initial investment. And what I've done is I've divided the cash flow into two parts. One is the land and one is construction. Okay. And inflow would be the sales. Okay. So I'll have to imagine a few things, but let's start here. Let's start with uh, the land. And here we are assuming that we have, see, the thing is that earlier what used to happen before RERA came in India, you could buy land, have a small portion of it, you pay 20% to agreement of sale, then you would get the title check, then you would pay another 50%. So the land acquisition itself used to take 8 to 9 months, and parallelly you started the project. But after RERA, what has happened is that before you register the project for RERA, the entire money for the land has to be paid up. So you technically your project would start after you acquired land, right? So I mean, technically the project cash flow could be longer here in this case. Okay, and if we were to actually do that, if I were to just increase the, let's say I'll do it for 1.18 months, that is 1.5 years. Okay, 1.5 years. Why have I added 6 cash flow here? Because here, let's say that here I'm just paying for land. Okay, and so from this 7.5 crore, let's say I paid 2 crores, and then I did a title check, so I didn't pay for the first one. After title was done, I paid another 2 crores, and then again I didn't pay, and finally at some point I paid remaining 3.5 3 crores 3 lakhs. Okay. So this is now my total cash flow outflow for the 7.5 crores that I have paid for the land. Okay, and for construction I didn't spend anything, so I'm putting 0. Okay, and it was only after the 4th month, okay, at this stage when my land acquisition was complete, and I went to RERA to register my project. It took me 1 month to register my project. Again, I'm just taking assuming here. So this is cash in, this is cash in again. This balance. Okay, so and again, this is for sales and this is for construction. I'll explain you what that is. Now, when we register the project for RERA, so it got registered, and I actually started my project, the construction, in month 6. So what RERA wants you to do is, RERA says you have to deposit 70%. Okay, RERA says deposit 70% of your construction cost in escrow account in a bank with RERA. so that they want to ensure that you will complete the project and customers won't be stranded. You won't delay the project. So we take 70% of the construction cost, is 3.48 crores, and we deposit it in there. Again, this is cash out. Cash out as in we are paying the money. It's going from our pocket. So the 70% of 3.48 crores would be, just calculate, 2.436 crores. Six is how many zeros? 1, 2, 3, 4, 5, 7. 2.43 crores is what we pay to RERA. So you can see that by this time, nothing has come to us. Our project is in negative. Okay. So if I was to take a balance here, we have a negative balance, okay, for our project. Till 6 months, we have just gone out of pocket. How to calculate the balance? This would be this plus this minus what's going out. That would be this plus. So what is coming in? So, and this is our balance. I'll just drag this. So our project is technically in minus, okay. And because I want to do this cumulative, so I think the way I should do this, no, just keep this. This is what it looks like. And so we are in negative. Every month our cash flow is negative. And it is only after once we start the project, we start selling and we'll start getting something out of sales. Okay, so let's say in month 7, we start selling. So what are we selling? Okay, so we'll have to assume a few facts here. What are those facts? Let's say our project is 27 crores, that's total value, and the market price is so and so. And let's assume, with assuming it, because normally you need to calculate. You need to calculate that if you are providing apartments, let's say that, and the apartment super built up is 1500 square feet, how many apartments can you make from the total available super built up? So this divided by 1500, I can sell 32 apartments. Okay, I can sell 32 apartments of 1500 square feet of super built up area in this project. Okay, this is again a rough estimate. And I know that my total project value, again, if I'm selling it at this price, would be around 27 crores. And I can also, you know, calculate it differently, but I'm taking a round figure of 32 apartments. And so the price for each apartment would be, let's say, 27 crores divided by 32. And so my one apartment is roughly 84 lakhs, 84.37. So I'll just take this number, okay, and just copy this number, and I'll just put it here. That is in our first month, let's say I just sold one apartment. In my second month, I sold 3 apartments. Let's say that. This is the money that is coming from the sales. I know you would be saying that first they'll only give about 10-20%, and 80% they'll take a loan. But here we imagining that we're just taking an imagination that we're doing 80-20 scheme, and 100% of the money for the project is coming, because I'm just trying to explain you how to do this. So we take the same number again, that this and multiply it by 3. So if we sell 3, this is what we get. Now, for land, we won't be spending anything more. So this will all be 0. Okay. All the way till cash flow. So this is 0. Now, for construction, this is a little tricky. You have already paid 70% in RERA. So what happens that after you start constructing every month or every 3 months, your engineer gives an assessment of how much work is done, and that is forwarded to the chartered accountant. Chartered accountant signs it that yes, so much work is done, and they present the bill to RERA, and RERA will start giving out from this back to the builder. It's a little confusing, but what they will do is at any given point of time, they will at least have 70% with them. So until you do not spend your first 30%, which is remaining, you cannot claim anything from the escrow account. So initially, you'll have to start. Did everybody get it? What I just said,
Come, sit.
guys? Did you get what I just said? Can you guys speak up?
Can you please repeat it, sir?
Yeah, sir, a lot of disturbance is coming.
My voice is breaking.
Yes, sir,
So,
a little bit.
so what I'm saying is that this amount is the 70% you paid to RERA. Okay. And this you cannot claim until you spend the remaining 30%. So what we'll do is for the next 2 months or rather 3 months, I'll equally divide what is to be spent of 30% of this. Okay, which is the last part. So it is around 1.044 crore. So I'll just and that I'm equally dividing into 3 months, just for the convenience. So this is what we're spending in construction. And so you won't get your money back from this until you spend this. So you'll start claiming all these 3 here. And so you can get all these 3 here. So you can claim this 30% that you spend, and this you will get this money you'll get back from the RERA authority. But see, my point is that this money is gone, you spend it. So you cannot consider this as money that has come in from construction. So I'm going to delete this and we're going to stick to sales. And so we can totally get rid of this. I had put this so that I could explain you that you do get your money back, but you cannot count that in the profit. The profit is only the sales. Okay, this is the only profit channel that you have. You do not have any other profit channel. The money is coming only from here. Okay, this is where your money is coming. So this is how you're going to spend for land, and this is how you spend for construction. And so now all you care about is how is the money coming back. So 4 apartments sold. Okay, 1 here, 3 here. I'm just going to drag this. 3 more sold here. So this is how you create your cash flow. So if I was to write a detail here, I would remove this. Sorry. I would remove remove those. And just drag this. Drag. Okay. So this is how my cash flow is coming through after selling this. So ideally, what I'm looking at is this is my monthly net balance. But what I'm looking for is cumulative balance. So technically, this shouldn't be zero, right? This should be added here. So I should get net cash flow. Okay, this is just a balance cash flow. But if I'm looking at ideally a cumulative cash flow, and what is the cumulative cash flow? Well, it is this. Okay, this would be this plus this. This would be this plus this. So you can set a formula and do this. This is my cumulative cash flow. Are you guys getting me?
Yes, sir.
Yeah, this is my cumulative cash flow. And I don't know if I can drag this. Let's see. Is this accurate? Nope, it's not. I can put a formula I know for all this. Right now I'm just doing it manually. Okay, I'm still in minus. Okay. Okay. I think there is a hashtag formula I can insert and it will do a cumulative for me. I'm just adding randomly right now. So far so good. Okay, I'm going to stop. This is the last one, and then I'll just explain what I'm trying to do. I'm not going to add all this up. I'll send you this sheet added up. Okay. Okay, let's focus. I'll remove this. This is wrong. Okay, till here we've done it right. So let's focus on this cumulative cash. We're still in negative, and I think from this month, that is month 7, uh, we will slowly from a negative 9.9 crores, we'll start slowly crawling back because now our sales have kicked in from this point. Okay. And so what I want you guys to do is at the end of the 18 months, when you reach here, you need to take this cumulative cash flow and calculate the net present value and internal rate of return that we learned in last semester, right? I taught you, right, in the IPE subject, guys.
Yes, sir.
You guys remember, right, how it was done? So,
Yes, sir.
you are selling one apartment here versus three, three, two, one, three. So I don't know how you sell whatever you are making. So depending on the best case scenario, the worst case scenario, and most likely scenario, you will have 3 cash flows here. And so this cumulative cash flow will be for 3 scenarios. So what I want you guys to do is to calculate the NPV, the IRR for the best case, most likely case, and the worst. And once you do that, uh, you can do the probability analysis and see what is the risk factor for this project, what is the expected value, which you learned last semester, I believe. If you didn't learn, I'll redo it in our next class on Monday through WebEx. But any questions so far? Because I want to relieve you with this meeting. Guys?
Sir, I have one.
Yeah.
Sir, you said that we have a cost of land and we have cost of construction,
Yes.
right?
Yes.
Which are basically outflows.
Out.
So can we add some percentage to it to consider the RERA registration or any other thing other than that? Just
Okay. No, it's a
some,
very it's a very good question. See, there are things you need to add, like the amount of stamp duty you will pay, uh, the litigation cost. You need almost 20 NOCs. Okay, so there are a lot of legal costs that are associated with this project. You need the airport NOC, you need a NOC from the
yes.
fire department, which I'll be taking in future classes. What those NOCs are and how to get them. But what happens is that this price of 84 lakhs is over and above all the taxes or fees that you have to pay. Because what normally developers do is they keep a separate amount for AMC, ORDA, RERA, which is paid over and above. So you don't need to include that. You can technically include that if you want to make a very robust model. But for the benefit of just simplistically understanding how it is done, once you do this without adding those taxes, you can in future improve upon it. That what is the profit before taxes? What is the profit before paying all this? Because see, you will be paying for all these taxes and permissions much before the project is over. So the interest of that would be accumulated, and eventually you are collecting it from the customer with interest or without interest. That is another story altogether. Technically, you cannot collect that with interest because you have to give a specified report as to what you're collecting it for. If you're collecting, let's say, 4 lakhs over and above, so you have to tell them that 50,000 is for the AEC, electricity, 40,000 is for, you know, your maintenance fee, this is for parking, this is for the stamp duty, this is for the RERA charges. So you have to give a detailed, you have to show what it is that is collecting, and all this is audited by the chartered accountant. So it's a question. Some builders do include interest, but it is very dicey to include interest because you applied for a permission on a certain day, the permission came after so many days, and there is a lot of cash that is involved in getting this permission. The corruption in India. So I would say keep that portion out. Because why are we doing this? We're doing this to ensure if the project is feasible or not, right? You're not doing a live tracking here. Live tracking, yes. If you are the CFO of the company, Chief Financial Officer, who is responsible for real estate projects, you would be doing all that. But you will be doing all that sitting with your chartered accountant and doing it because you may not have all the information on hand at any given time. But we will take a separate class on what those fees are. I have planned it once I explain this to you because I don't want your projects to get stuck. So you can start working on your project. You can start thinking what you're supposed to make and what the prices are. And that's why I took this little early. So once this is done, I'll switch to all those litigations and bylaws and all those aspects which are important to consider in your project. Are there any other questions? Any doubt in what we've done here? Guys?
No, sir.
Okay, you understood, right?
The assignments be?
The assignments I've received, I have not checked them. I'll check them this weekend. this is the most important column for you because your NPV in IRR will be calculated from this column. Okay. Your cumulative cash flow, which is this minus this. Okay, whatever you have here. So this will be till CF18. And when you input the percentage for NPV, make sure you do it for monthly. So if you're assuming a discount rate of 12%, make sure you put 1% per month because these cash flows are monthly.
Yes.
Okay, so what I'll do is I'll try to complete this sheet and I'll email it to you as well as same time in our next class. I'll show you. We'll discuss this sheet very briefly what I've done before moving on. Okay. And in the meantime, you guys can get started on your project.
Okay, sir.
Okay, so I'm going to stop share, and we can still, if you guys have time, I know you have something at 11, but if you have anything else, we can discuss. Anything else? So no questions then. I think what we'll just download the WebEx Cisco app on your mobile phone, and it will be pretty much the same what we've done with this. And our next meeting on Monday, let's plan with the Cisco WebEx so that we don't have to stop in between. Okay, guys?
Okay, sir.
All right, then I'll see you guys on Monday and I'll complete this sheet and email it to you guys or just share it on the group by tomorrow. Okay?
Yes, sir.
The Excel
Okay.
sheet, the Excel sheet that I just showed you as a sample. All right?
Yes, sir.
Okay.
Okay.
Have a good weekend, guys. Good luck on your presentation. Chalo. Someone shouted really bad.